Hello everyone and welcome back to Wealth Wizard. In today's video, we'll be discussing the important topic, Warren Buffett's warning and its potential impact on the real estate market. Warren Buffett, often regarded as one of the most successful investors of all time, has provided valuable insights on various market conditions throughout his career. Recently, his warning about certain aspects of the real estate market has raised concerns and sparked discussions among investors. In this video, we'll delve into the significance of Buffett's warning and explore its potential implications to the rest of the real estate market. Who is Warren Buffett? Warren Buffett is a prominent figure in the world of investing. Born in 1930, he developed an early interest in business and finance. Buffett is the chairman and CEO of Berkshire Hathaway, a multinational conglomerate holding company. He has earned a stellar reputation for his investment prowess and has consistently delivered impressive returns over several decades. Buffett's investment philosophy is rooted in the principles of long-term investing value. He emphasizes the importance of thoroughly understanding a company's fundamentals, its competitive advantage, and its long-term prospects before making an investment. Buffett is known for his disciplined approach and his ability to identify undervalued assets in the market. What sets Buffett apart is his remarkable track record of accurately predicting market trends and making shrewd investment decisions. His insights and recommendations are closely followed by investors worldwide. As such, when Buffett issues a warning or shares his concerns about a particular market, it garners significant attention and can influence investor sentiment. Buffett's success and influence earned him the nickname Oracle of Omaha, referring to his hometown in Nebraska and his reputation for wise investment choices. His annual shareholders letter and public statements are highly anticipated by investors and analysts who eagerly seek his perspective on various market conditions. Considering Buffett's extensive experience, track record, and the respect he commands in the investment community, it's crucial to pay attention to his warnings and understand how they shape the real estate market's landscape. Let's delve deeper into Buffett's warning and its potential implications for real estate investors. Warren Buffett's warning on the real estate market. Warren Buffett, with his keen eye for market trends and investment opportunities, has recently expressed some concern about the real estate market. In his annual shareholder letters and public statements, Buffett has highlighted specific aspects of the market that have raised red flags for him. While his warning may not indicate an imminent collapse or a blanket condemnation of the entire real estate sector, it does warrant attention and careful consideration for investors in this market. One of the key reasons behind Buffett's warning is the potential for an overheated market. He has cautioned against excessive speculation and unrealistic expectations in real estate. Buffett has often stressed the importance of buying assets at a reasonable price relative to their underlying value, and he believes that when prices become detached from fundamentals, it can lead to a bubble that eventually bursts. This warning serves as a reminder to investors to be cautious and not get caught up in irrational exuberance when investing in real estate. Additionally, Buffett has expressed concerns about the impact of rising interest rates on the real estate market. As interest rates increase, borrowing costs rise, which can dampen demand for real estate and put downward pressure on prices. Buffett has emphasized the importance of considering the long-term effects of interest rate changes and their potential impact on the affordability of real estate investments. Furthermore, Buffett's warning may also be influenced by his broader views on the economy and market cycles. As an astute investor, he recognizes that markets go through cycles of expansion and contraction. While real estate has historically been a valuable asset class, Buffett's warning reminds investors to remain vigilant and aware of the potential risks associated with market downturns and economic fluctuations. It is important for real estate investors to take Buffett's warning seriously and assess their own investment strategies accordingly. By considering this insight, investors can evaluate the specific market and segments within the real estate sector that may be more vulnerable to risks. This can involve conducting thorough due diligence, analyzing market trends, and considering factors such as location and demand dynamics, and the financial health of the underlying assets. Factors affecting the real estate market. The real estate market is influenced by various factors that can have a significant impact on its stability and performance. Understanding these factors and how they relate to Warren Buffett's warning is crucial for assessing the potential vulnerabilities and risks that the market may face. One of the primary factors affecting the real estate market is interest rates. Interest rates play a critical role in determining the affordability of borrowing for real estate purchases. When interest rates are low, it can stimulate demand for real estate as borrowing costs decrease, making it more attractive for individuals and businesses to invest in properties. Conversely, when interest rates rise, borrowing costs increase, potentially dampening demand and putting downward pressure on property prices. This factor aligns with Buffett's warning about the potential impact of rising interest rates on the real estate markets. Economic conditions also play a vital role in shaping the real estate market. Economic indicators such as GDP growth, employment rates, and consumer confidence can influence demand for real estate. During periods of economic expansion, there is typically increased demand for housing and commercial properties. However, during economic downturns or recessions, the demand may decline, leading to decreased property values and potentially higher vacancy rates. Buffett's warning may be influenced by his assessment of the current economic conditions and his concerns about a potential slowdown of recession that could impact the real estate market. Supply and demand dynamics are essential considerations in the real estate market. The balance between the supply of available properties and the demand from buyers or renters can influence property prices and rental rates. If there's an oversupply of properties relative to the demand, it can put downward pressure on prices. On the other hand, limited supply and strong demand can lead to price appreciation and potential investment opportunities. Buffett's warning may relate to his assessment of the supply and demand dynamics in certain real estate markets, highlighting the potential risks associated with imbalances and the need for caution. Additionally, other factors such as government policies, demographic trends, and geopolitical events can impact the real estate market. Changes in regulations, tax policies, or zoning laws can affect the profitability and feasibility of real estate investments. Demographic shifts such as population growth or changes in household composition can influence the demand for different types of properties. Geopolitical events such as trade disputes or political instability can introduce uncertainty and impact investor sentiment. Considering these factors in light of Buffett's warning can provide insights into potential vulnerabilities and risks that the real estate market may face. Analyzing the real estate market. Conducting thorough research and analysis is crucial when evaluating the real estate market, especially in light of Warren Buffett's warning. By carefully assessing key metrics and indicators, investors can gain insights into the health of the market and identify potential risks. One important metric to consider is the supply and demand dynamics of the real estate market. Investors should evaluate the inventory of available properties in relation to the demand from buyers or renters. A high inventory level relative to the demand could indicate a potential oversupply situation, which may lead to lower property prices or higher vacancy rates. On the other hand, a low inventory level with strong demand could indicate potential opportunities for price appreciation and rental income growth. Analyzing these dynamics helps investors understand the potential risks and opportunities in the market. Property valuations are another critical aspect to assess when analyzing the real estate market. Investors should evaluate the prices of properties in relation to their intrinsic value. This can be done through comparative market analysis, where similar properties in the same area are compared to assess if the asking price is reasonable. It's essential to consider factors such as location, property condition, amenities, and market trends to determine the value of a property. By avoiding overpriced properties and focusing on those with favorable valuations, investors can mitigate the risk of paying more than the property's actual worth. Rental yields are another key factor considering when evaluating the real estate market, particularly for income-oriented investors. Rental yield is the ratio of annual rental income to the property's purchase price. It provides insight into the potential return on investment generated by rental income. Investors should compare rental yields of different properties and locations to identify areas with favorable income-generating potential. Higher rental yields suggest better income opportunities, while lower rental yields may require careful analysis to ensure the investment aligns with the financial goals. Mitigating risk and strategies. In light of Warren Buffett's warning against the real estate market, it is important for investors to adopt strategies to help mitigate risk and position themselves for long-term success. One key strategy is diversification. By spreading investments across different types of properties, locations, and markets, investors can reduce their exposure to any single property or market downturn. Diversification helps protect against the impact of localized factors that may negatively affect specific properties or regions. It allows investors to capitalize on opportunities in different markets that may perform better despite potential risks. Diversifying across residential, commercial, and rental properties can provide a balanced portfolio that is resilient to market fluctuations. Maintaining cash reserves is another crucial strategy. Having a sufficient amount of cash on hand allows investors to take advantage of favorable opportunities that may arise during market downturns. Warren Buffett himself has emphasized the importance of having cash reserves to capitalize on attractive investment opportunities. By having liquidity, investors can act swiftly when a high-quality property becomes available at a discount price or when market conditions are favorable for purchasing. Taking a long-term investment horizon is essential in the real estate market. Real estate is generally considered a long-term investment due to its potential for appreciation and steady rental income over time. Buffett's warning serves as a reminder to focus on the fundamentals of properties and their long-term value rather than their short-term market fluctuations. By maintaining a patient and disciplined approach, investors can ride out market cycles and benefit from the compounding growth of their real estate investments. Identifying opportunities in the real estate market is crucial for success. Despite potential risks, there are still opportunities for investors who approach the market strategically. Focusing on quality properties in desirable locations is one approach. Properties located in areas with strong economic growth, good infrastructure, and access to amenities tend to be more resilient during market downturns. Investing in properties that meet the needs and preferences of the market can help attract reliable tenants and generate steady rental income. Targeting niche markets can also present opportunities. Identifying underserved segments of the real estate market, such as student housing, senior living, or short-term rentals, can provide unique investment prospects. These niche markets often have specific demands that can lead to higher rental yields and potential for capital appreciation.